The Walt Disney Company just reported their Q1 fiscal year 2024 earnings report. They reported a double beat, even raised guidance with regards to free cash flow. They increased the dividend payout, and they're starting back with buybacks. There were also a couple of other nice announcements that I did not expect. One investment in Fortnite maker Epic Games, a $1.5 billion investment there. I believe this is a move for Disney to get a bit more exposure to the gaming space. They've got the IP, so why not? And then secondly, they have plans to form a joint venture with Fox and Warner Bros. Discovery to launch a streaming sports service. The official launch of a standalone ESPN service is planned for the fall of 2025. So, quite a nice report for Disney shareholders, but I do have to say this, even though I have put Disney in the top stocks for 2024, I do think it's a bit too early to celebrate right now. I'll explain throughout this video. Alright, let's first start with some comments here from the CEO Bob Iger. Just 1 year ago, we outlined an ambitious plan to return the Walt Disney Company to a period of sustained growth and shareholder value creation. Our strong performance this past quarter demonstrates we have turned the corner and entered a new era of our company, focused on fortifying ESPN for the future, building streaming into a profitable growth business, revigorating our film studios, and turbocharging growth in our parks and experiences. As we build for the future, the steps we are taking today lend themselves to solidifying Disney's place as the preeminent creator of global content. Looking at the renewed strength of all of our business this quarter, from sports to entertainment to experiences, we believe the stage is now set for significant growth and success, including ample opportunity to increase shareholder returns as our earnings and free cash flow continue to grow. Now, it is very important to note here that despite the streaming side of things becoming more and more profitable, a lot of the profits that you're seeing right now are coming because of cost cuts, more specifically job cuts. Very important to note, and also the delay of a lot of movies. So the cost of those get pushed a bit further down the line. Now, before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I really appreciate that. I really appreciate all the support you have been showing me these last couple of weeks, especially with regards to the earnings season. So thank you very, very much. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's have a major overview here. Revenues came in basically flat year over year, $23.54 billion. Income before taxes increased 62% year over year. Total operating income segment increased 27% year over year. And so diluted EPS is up 49% year over year. And EPS excluding certain items is up 23% year over year. And then of course, if you look at the difference between cash provided by operations and free cash flow this year compared to last year, huge difference. Basically, last year was outflows, now you've got inflows. Then with regards to the different segments here, I believe this is the second or the third quarter that they show us the earnings report like this. So basically revenue split into entertainment, sports, and experiences. Entertainment is down 7% year over year. Sports is up pretty strong quarter. Sports is up 4% year over year. And experiences is up 7% as well. Now, with regards to experiences, remember, they previously mentioned that they're going to invest around $60 billion over the next 10 years to turbocharge the growth in this segment. I believe this was very, very well received. Even though it is a lot of money, I think they had to do it, right? You cannot continue to raise your prices for your parks when nothing changes. I know there have been some innovations, some new additions to the parks, but a lot of the rides, a lot of the experiences are not really made for the age of technology, AI, VR, AR, stuff like that. So, good move. Then with regards to the profitability side of things, entertainment increased over 100% year over year. Sports, while still losing money, an improvement of 37% year over year. And experiences, still the money maker for them, up 8% year over year to $3.1 billion. Now, looking at entertainment specifically here, we have, of course, linear and direct-to-consumer. Linear continues to go down 12% year over year. Direct-to-consumer is up 15% year over year. But then when you look at the profitability of things, especially for the streaming side of things, since 2024, especially Q4 2024, this segment is supposed to reach profitability. If they can continue to grow at this rate, I mean, it's up 86% year over year towards profitability. I do think we're going to get there before Q4. Now, with regards to the subscribers, Disney Plus Hotstar increased 2% year over year. But if we look at the Disney core, it's down 1% year over year. Same for international, same for domestic US and Canada. It's down 1% year over year, probably due to increases in prices. With regards to Hulu, total Hulu increased 2% year over year. Now, with regards to average monthly revenue per paid subscriber, for domestic US and Canada, that increased 9%. Again, price increases does help. Internationally, decreased 3%. Disney Plus core overall increased 2%. As for Disney Plus and Hotstar, they increased 83% year over year. But of course, if you look at the difference here, price paid, I mean, $1.28 compared to US and Canada, $8.15, not that much. Then with regards to the experiences, basically the parks, domestically that increased 4% year over year with regards to revenue. Internationally continues the nice momentum here, up 35% year over year. With regards to operating income, domestically that's down 2% year over year. Internationally, still continuing that trend yet again, up over 100% year over year to $328 million. Of course, internationally, much smaller with regards to operating income than the domestic parks. Now going back to what I mentioned at the start of this video, so in February 2024, the board of directors approved a new share repurchase program effective February 7th, 2024. They plan to target $3 billion in repurchases in fiscal 2024. And of course, the board also declared on the same day a cash dividend of 45 cents per share, an increase of 50% versus the last dividend paid in January, payable July 25th, 2024 to shareholders of record at the close of business on July 8, 2024. So definitely appeasing the, let's say, older shareholder base here, returning some value to shareholders. I do think with the pressure of activist investors such as Nelson Peltz, I think whether they want to admit it or not, I do think they had a positive effect. Then with regards to outlook, should I say, so they said here we are on track to meet or exceed our $7.5 billion annualized savings target by the end of fiscal 2024, while we continue to look for further efficiency opportunities. Based on the strength of the first quarter results, as well as our expectations for the balance of the year, we expect full year fiscal 2024 earnings per share excluding certain items to increase by at least 20% versus 2023 to approximately $4.60. Further, we continue to expect free cash flow generation in fiscal 2024 to total roughly $8 billion. Certainly a better outlook to what we've gotten with regards to PayPal, for example. I mean, the bar for Disney was low, but at least they exceeded, they beat, and they raised. Now, with regards to their guidance for EPS, right, they set 20% growth year over year, $4.60. Well, it is higher than what the analysts were expecting. As you can see, for fiscal year 2024, EPS $4.34, year over year change of 15.51% year over year. So, beating analysts' expectations at the start of the year is a pretty good sign. And then for fiscal year 25, analysts are expecting it to grow another 21% or so, followed by a 13.27% growth year over year in fiscal year 2026. So overall, pretty good report by Disney. Good, let's call it, outlook guidance for 2024, especially with the announcement of buybacks and increase in dividends, most cost savings, let's say free cash flow, $8 billion. Let's see what happens with the content slate, because that's still something that they are struggling with. Believe it or not, they're not making that much money on the latest big movies that came out. So let's wait and see. But right now, I mean, the market is liking what it sees. It's up 6.16% at the time of making this video. Company is becoming more profitable. Yes, also because of cost cuts, also because of layoffs. So that will be it for this video. Of course, do share your opinion down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.